Ladies and gentlemen, our first session dives into a subject that lies right in the heart of NBFC growth and resilience. Credit analytics and underwriting, building a 360-degree perspective. Now let's pause and think, in an economy vast as India's, how do NBFC actually decide who gets the credit, how much, and at what risk? Okay, now that's something that probably the leaders will answer, but this is no longer a balance sheet or probably a CIBIL score anymore. Today, credit-based decisions are taken on AI-driven models, vast scope of data, and of course digital footprint, of course alternative credit score, and most importantly even behavior analytics. That's what I have heard. Well, underwriting now definitely demands a 360-degree view and perspective of customer, just not their ability to repay, but their ability, intent, their patterns, and of course, ecosystem risk. So let's call upon our panelists, because we have a very power-loaded and power-packed experts coming up on the stage, sharing their key insights.
Hey, good morning, everybody. First of all, I think a great day to have this session when the clouds have opened up and we don't have rains. I think a bit of a fear that if this event would go and pass the test of time, and we do. So thanks everyone for being there this morning. Let's just, before we dwell into the questions, I think we heard from the esteemed folks prior to me who spoke about, the fact that how NBFC is an important sector. And I think one of the important areas within NBFC is about credit and how underwriting, and we speak about analytics and underwriting together, but it's important that how we do underwriting, and that's what we'll dwell in with my co-panelists today. So I think I will go straight into Vivek in terms of the first question. In your experience with your role in Agriwise, where you're the CEO, how you think the role of credit analytics is evolving, in terms of if you have any use cases in terms of, how it's evolved? Because Vivek, be aware of the fact that the traditional analytics is purely based on, looking at balance sheets, credit worthiness from the various credit agencies. But, what's that more you're doing in your day-to-day role to ensure that, we get the whole underwriting right in your organization?
Okay, so first of all, good morning, everyone. So if we talk about credit analytics, if we talk about current financial scenario or landscape, so all the commercial lenders or NBFCs, banks or financial institutions, they are increasing their credit analytics as well as the data analytics on day-to-day basis, right? And if we talk about their working style, now they are shifting their focus from balance sheet analysis or ITR or banking analysis to some kind of behavior analysis as well as the actual cash flow analysis. And that is also supported by the some real data, right? So if you talk about the complete loan journey, right? So from starting itself, the first step is definitely the lead generation, right? And the credit login. Right, so on the basis of predefined BREs, business rule engine. So on the basis of that, the in-principle approval can be given, right? So customer can get the in-principle approval within a second, and on the basis of that, he can be retained with particular NBFC or financial institution up to the final approval, right? So it can be the first step. If you talk about the second, so second can be the correct ROI measurement, right? So on the basis of that BREs, or on the basis of market scenario, or on the basis of behavior analysis or the risk profile or the customer profile, right? So we can find out the correct ROI, correct commercial for that particular borrower, right? So it can be beneficial for borrower as well as the NBFC, right? If we talk about the third step or third position, though, we can say that credit risk assessment, right? So we were talking about the balance sheet analysis, or we were talking about ITR or banking. So on the basis of that, we can do the sanction, right? Fourth one we can say is LMS, loan management system. After the sanction, the role of LMS is too wide, right? So on the basis of e-NACH or on the basis of digital documentation, so again the credit analytics is there. So on the basis of that, we can work upon the reduced that turnaround time. And after that, if we talk about the collection, if we talk about the EWS, so again, complete data analytics is there. And again, next point can be some kind of regulatory compliance, right? So for the reporting of the correct manner or correct data, the figures should be from that particular analytics. And the last point, if we talk about, it can be the biggest issue of the NBFC right now. It's a customer retention, right? So on the basis of that analysis, we can find out that who are the customer who are most likely to leave you, most likely to leave that particular NBFC on the early stage, right? So we can work upon that data to retain the customer. We can work upon the requirement, or we can work upon the need of the particular customer, so that it can be retained in particular NBFC for the longer period. So these are the benefits if we talk about the credit analytics and the data analytics in current financial scenario.
Thanks, Vivek, for that. So I'll just, so we got Shalinee, who is at the role of a CRO at Godrej. Shalinee, risk, when you talk about underwriting, you're actually underwriting risk. Basically you are taking up a liability in your books, and in terms of ensuring that the right customer is something you're onboarding. So from a risk parlance, from a risk lens, how would you say analytics plays an important role? What is that you're doing in your organization to ensure that the right set of customers are getting onboarded, ensuring that the whole life cycle, from the time you onboard a customer, you disburse the loan, from the time to the person repays. In the whole journey, obviously the idea is that you lend and you take the principal and the interest back from the customer. That's the whole gambit of lending. So from that parlance, how does analytics play an important role from a risk parlance in your view? Yeah.
Yeah. Thanks, Ram, and thanks everybody for having me here to share my views and experiences. First of all, I would say that these loans and advances, these are assets for us, not a liability, right? They earn revenue for us. Credit analysis is no more a support function in today's environment, and it is very much at the forefront of any strategy. With so much data around, and if you're not able to put in the right drivers, right ways of analyzing the data, your decisions can go wrong. So at Godrej Capital, the way we use credit analysis is for predicting, for protecting, and for preventing risk, right? So if you look at all these three, in each of these pillars, for example, if I talk about predicting, how do we predict the repayment behavior of a customer? So we have, scorecards, and we have multiple scorecards. Gone are those days where you have univariate scorecards with so much of data, around. A lot of data is available in terms of the financial statements, bank statements, and you also have a lot of alternate data. So we are able to, converge all of that, make a meaningful analysis. So we've got scorecards which help us in predicting the behavior of the customers, because it's all about managing risks at the end of the day. So we use scorecards for predicting, for preventing, again, how much lending are you doing at the bottom scorecards, how much you are doing at higher scorecards, and what is the right pricing. So we use scorecards not only in predicting, but also in right pricing, pricing the right risk. That's what we use. Again, we also use it in preventing. So as Vivek just mentioned, that it is also used in collections. So we use analysis in collections as well. That is, how do you layer the customers, segment the customers who can pay, who have a good repayment behavior, in the sense that just by calling they pay. So you bucket those customers in a different segment, and you have different collection strategies for them. So the entire life cycle of the customer, we use analysis, and credit analysis, when you use the word, it's all about, how well you can analyze so that you get the best output. The other thing which we also keep in mind is we always put customer at the center of any kind of a strategy. So, we use analysis also for tracking, foreclosures, right? Because it's with a lot of effort we onboard customers, and when you see those customers attriting, it hurts. So we also build models around, which are those segment of customers where you have attrition rate can be higher. And it's a proactive way of ensuring that we come out with some kind of a solution or strategies to hold the customers with us. So that's another area where we use a lot of analytics. So we also use analytics in, understanding the behavior of the customers. When we have enough customer database with us, we also work on cross-sell, upsell. So it's all about managing your AUM, ensuring whatever you have built, you hold on to it. And if you don't use the credit analytic tools, it becomes really difficult, because gone are those days where you can manually call each and every customer, or look into bank statements or GST statements or tax returns or financials. It takes a lot of time. Those traditional ways of underwriting and all are become kind of a history now. So the sooner that was a conscious decision, because Godrej Capital, we came into life during COVID times. So in those days, the human touch was absolutely not there, and we had to focus a lot on technology and analytics. So all our strategies are based on tech and analytics, and we are forced to, that is the constraint which we have, that we have to use technology, we have to use analytics, and then that leads to a lot of solutions. Thank you.
Thanks, Shalinee. For the insightful message on analytics within your organization. Yasoda, in terms of in your role as a strategy officer, in terms of while Shalinee spoke about risk, before you get the customer, obviously there's that. We try to ensure that the right customer is something we onboard, So from your standpoint, like from a strategy standpoint, how do you strategize to ensure that the right customer, the persona we talk about, is something which we target from the market? So how do you ensure, before we do an underwriting, trying to do a pre-check in terms of how do we onboard the right customer, in terms of, if you could provide some insights from your viewpoint, from a strategy standpoint.
Okay, thank you, Ram. So I must introduce Fynx Capital, what we exactly do. Fynx is a NBFC which is registered with RBI, and it's BSC listed company. We primarily doing, so I'm introducing so that I can relate with what you actually asked. We primarily engaged in supply chain business. Apart from that, we are always look for some innovative product where we can actually go into that segment which is not served by the bank or even in the larger NBFCs. So if it is not served by the NBFC, so I'm coming to the context what you have asked, the pre-underwriting perspective. So the kind of customer we are actually serving, which is at the bottom line of the customer pyramid. So where probably you may not get that data, which is structure format data, like probably you may not get financials, old financials, registration, and kind of data we look forward for the underwriting. So generally we rely on the data, which is alternate data, as Vivek and Shalinee mentioned, which is alternate data, which is with the behavior perspective, which is, let's say, in case my credit underwriter goes to any of the person or a borrower, so he generally observe more of the behavior, observe integrity, beliefs, and understanding the repaying capability. So this is something which is not in the paper, but in any ways we are supposed to collect the data from the customer, which is in any ways probably may not have that authenticity. And then it is not in the format which we look forward for the underwriting. So these kind of parameters, we always try to look at the customer, which is there. So sometimes it's very difficult to for the believing the underwriter also, in case they come with the belief कि मज़ा नहीं आ रहा, feel नहीं आ रहा. So in that case, we come with the context कि feel क्या होता है. In any ways, whatever the information we required, it is there. But then we give this advantage or weightage to the underwriter, feel na aane wala bhi. Because in any ways, this is something which has been there, which has been observed. So these kind of things, we always look at those kind of customers. And for that matter, I can give you the example of what we do at Fynx is, we are also serving gig workers. And gig workers is the perfect example of not having the data which we require for underwriting, but then in any ways you come with the beliefs and then other alternative data we collected from the customers. So this is, at the same time, we cannot expect this data to be, we can be analyzed through the AI and ML also. So getting the data, putting in our own parameters, what kind of belief or what kind of observation, how much weightage we want to give. So that is based on those parameters that this is, let's say if we say the borrower is staying at the place for 20 years and his shop is it is there for 5 years. And at the same time, another one has 1 year of vintage in the shop and 5 years of the residence. So it is again to be understand that what kind of weightage we are supposed to give in the underwriting entire process. So these are the kind of challenges we face, and we have our own underwriting process for the weightage, that this much of weightage we can give for the underwriting. So this is how we do.
Thanks, Jasoda, for that. And I think you brought the next question from my side to Ajit, sir. Ajit, I think we met in the past also in other panels. And there's a lot of conversations we've had, and I think this question will be something which I think you will love to answer. All three panelists before you have spoken about data. And I think the greatest challenge is in terms of structured and unstructured data, in terms of how do you build it into your analytics model, While the structured data, is that, you have your credit rating agencies giving you those numbers, but there are, like Yasoda spoke about, some, the fact that behavioral, that's data is you do not know, it's not there in the open, you probably have to look at social media and all the other channels to get this data out. So in your opinion or in your role as a Chief Operating Officer at Vivriti, how do you keep structured and unstructured data in credit analytics and underwriting? What's any use cases if you want to share with us about?
Sure. I have an alternative investment fund. The assets exceed 4,000 crores there. We manage about 11,000 crores ourselves. Primarily mid-market space, like Jasoda mentioned, is a space which is largely, for us, it is touched by banks and also not touched by banks, right? So that's the sweet space. It's called a space called the mid-market space, where we deal with corporates and emerging corporates. So somebody who would have a turnover of 5 crores going up to 2,000 crores. And our loans our enterprise loans are largely granular. And, we can go up to about 45 crores, going up to a tenor of 3.5, 4 years, right, at best. So we are primarily only debt capital providers, right? And we provide debt for a whole host of reasons. We have about 350 clients, about 20 odd sectors, different structures. We also have a supply chain finance book, all of that, and something that Jasoda manages, right? So I think, we are largely diversified that way. So let me take your question, right, in terms of how do you deal with structured and unstructured. The first investment that any financial services company in the times like these have to make, or rather over-invest, is to have a very robust data team and have a data lake. Unless you over-invest in compliance, that's a regulatory aspect. The second most important investment you would need to make is into a data team, where the unstructured data needs to be tabulated and available for you to be consumed in such a fashion that you make sense out of it. So there is a lot of noise and less of signal. So how do you then separate the signal from the noise? So do such activities which improve your odds to get the signal and reduce the noise, because noise will always by design be more as compared to the signal, because the signal is generally garbled, right? How do you go about doing this? It all depends on the asset class that you're dealing with. Let's say consumer loans. It's evolved. It's to the point where unless you're, like Shalinee said, it's all the propensity model that comes into play. If your propensity model talks about how a consumer behaves in a certain credit score with a certain income in a certain PIN code, he could be nice to you but may not be nice to another lender. I'm talking about concurrent loans. Let's say somebody has a 50,000 rupee personal loan and has a 90,000 rupee personal loan or a 1 lakh rupee personal loan with another entity. Your model should be able to tell you that in the next 2 months to 3 months, he will default. Now, whether you are having exposure to the 90,000 loan or the 50,000 loan, how he would behave is something that your model should spit out. And then take out the specific actions from the model for you to take corrective action. Now, largely it's unsecured, but the model should basically then enable you to look at data and say, what should be my next step? Should I reduce exposure to a certain credit score? And should I not go after certain PIN codes? Today, the CICs are also largely data-driven. So depending on multiple reports that you could subscribe to and your own model, it has to be a mishmash of both. And it is always proprietary. And that is the mode for every lender, depending on the asset class. We are present in largely all asset classes. It could be two-wheeler loans, commercial finance, MSME loans, enterprise loans, financial services loans. So it's a plethora. So the risk team, at Vivriti, a good friend of mine runs it, Hemang. He would definitely have teams. He has teams which basically are spread across these asset classes, and there is a propensity model for every asset class, every engagement. Risks are very different in co-lending in that specific asset class. So there are multiple subsets as to how you manage risk. The entire overlay is data. This is all stitched on data. So unless your data strategy is to the point where it gives you the signals and not give you too much noise, is how we go about it. And that's how the larger NBFC today, which is not a bank, I don't want to name them, actually the foundation is so strong that it's actually based on data, right? And then that's how you build a business on top of data. You can't build the other way around. You can't build a business and then say, I'll take care of data in 3 years. It doesn't work like that because your models collapse, right? So I hope that gives you a signal as to how we do it. And that's how, see, it's all about non-linearity. Having a data team doesn't mean you have to hire 100 people. It means you just have 4 people, but you use a lot of technology to do a lot of heavy lifting, which then enables you to have the right models and the systems. The world that we live in today is all largely generative and agentic in nature, right? So you don't need too many people to do all the heavy lifting, just that you need to have the right models. Yeah? I hope that answers it, Ram. Yeah.
Absolutely. And actually, it leads me to the next question to you, and I'll come in reverse order now.
Sure. No problem.
In terms of, Ajit, in terms of, we spoke about data and you spoke about generative AI also. It brings a thin line between compliance and innovation, and somewhere, you need to be careful in terms of when I'm compliant and non-compliant. So in your opinion, how do you ensure that, I'm not pushing the needles too much, which can lead to non-compliance? So, yeah.
I think the regulator is, we have one of the finest regulators in the world. Let me put it that way. Worked abroad, lived in different countries, worked with another regulator abroad. I'm not saying they're bad. I'm just saying that we are actually at the cutting edge of a lot of things, and we are extremely proactive regulator, right? Now, there is a lot of leeway that the regulator provides. That perimeter should not be breached. And when it comes to models, the models have to be proprietary. So when you're working with, let's say, something like Llama, or when you say you're working with a large language model, you've got to repurpose. See, these are general purpose LLMs, which you will have to subscribe to and then build a model for your own data. It has to be contextual to your data. So unless you have a sandbox, unless you have that model training on your own data, say for example, when we met last year for our strategy meeting, my colleague, the chief data officer, presented 2, CAMs. Shalinee and all of us can relate, a credit assessment model, a CAM sheet, which basically talks about the lowdown on the company, the financials, the risks, the industry, relative attractiveness, plethora of risks, whether you should lend, not lend, what could be the outlook in 5 years. That was written by a human, and then he generated a CAM. This was last year. He generated a CAM, which is basically generated by a GenAI model, right? People could immediately point out which was written by a human and which was written by a Gen AI. That's because it also takes it, and it accelerates, because the technology is today at an accelerated cycle, right? So there are many generations of leap that you have essentially taken, right? So it is not the computerization era. Today, there are a lot of people who have moved away from, there are the people who've moved, not accessed the internet on a computer, but have accessed internet on a smartphone. So that there is a generation which has taken that leap. And it is also driving the unit cost down to consume, let's say, fractional compute, right? Now, which I did mention in the morning, right? So when it comes to all of this, you do not need a lot of resources to build a viable model which works for your own organization. And my suggestion is every organization should build a tailor-made model which works basis the aspiration that you carry, right? So if you need to expand in 4 different asset classes, you need to have data models which cater to those asset classes, which then enables you to take decisions and keep the risk levels low, right? Because you do not want to take a higher ECL, etc. You want to know that in 6 months I would have this ECL. So a glide path, right? I don't want to be at that month and say that my ECL is now 8. I did not know, what this ECL is, and I did not know how I got here. So that's not the right way to go about it, right? So that shows in our balance sheet, right? Our NNPAs, GNPAs are in single digits, right? That's primarily because of the early calls that you take. The early calls are only possible if you have the right data structure, right? So I will again re-emphasize the importance of investing in data.
I'm informed by Shalinee that she is short of time, so
sure.
I will put the next question to Shalinee, in appreciating that she is short of time. Shalinee, in terms of traditional underwriting models, how are they challenged? How are they challenged the current environment in underwriting, and from an analytics standpoint, in terms of what do you think are the roadblocks, in ensuring that the models are there to the test of time, the challenging the test of time. How is that happening?
Yeah. So as I mentioned earlier, we always keep customer as our focus. So it's very important to ensure that we are able to turn around cases faster. Speed is of essence, right? That can be one big differentiator when you are competing in this industry where there are so many players, same customers, a lot of them similar customers are, borrowing from multiple lenders. So it's very important with the kind of speed, with the kind of accuracy. If you can predict, you can have your models, because that doesn't happen with the traditional traditional methods of underwriting, which is like, you are looking at bank statements, analyzing them, you're doing a personal discussion, you just have data which is in terms of financial statements. You can't do underwriting only basis financial statements anymore. And there is another segment which is coming out, which is new to credit. So if you look at the performance of a new to credit segment and compare with a credit tested customer, you'll find a new to credit customer is often at par with a medium to high score customer. A poor score is definitely bad, but a new to credit is certainly superior to a poor credit score customer. So how do you underwrite a new to credit customer? The traditional way is, you go there, you make a P&L of the customer, which still exists. So don't get me wrong, because that's still important. But if you can get a lot of insights through other alternate data and then synergize, put everything together, you are able to ask the right questions. And that's very important, right? So in today's, scenario, you have multiple alternate data, and how you are able to use that is the important. And that challenges the traditional way of underwriting in a big factor, because the speed, the accuracy, it reduces a lot of biases also, because what Jasoda also pointed out, right? Ye case acha nahi lag raha hai. You remove those kind of biases because you have enough data to say, okay, this is the utility payment behavior of a customer. These are the kind of expenses the applicant is normally getting into. So you can make a straw man, a profile of the customer in split seconds. And when you have everything ready with you, you just have to make your decision. So decisioning becomes faster, much more accurate. And I think that's how it challenges the traditional. So we are constantly challenging our ways of underwriting in today's world, because the way technology, the way use cases for AI, ML, they are emerging. All these are ways of challenging and coming out with optimal solutions.
Thanks, Shalinee. I think that puts the questions to Jasoda in terms of we spoke about opportunities, but obviously there'll be challenges, in terms of there would be roadblocks. So what, in your opinion, is the biggest challenges in from an underwriting and analytics standpoint? What are those roadblocks in terms of, and how do we overcome that, basically?
Okay. So we always should understand that when it comes to the underwriting in Indian economy and Indian NBFC or banking system, it's been very difficult to go tech side, completely 100% tech side. As Shalinee just mentioned that believe it or not, but then it is there. In smaller case, small ticket size cases, we always need to have the physical system where technology is also there and where the physical touch with the customer is also there. So when meeting this parameter, yes, it is there to understand more of those points which is not available in the document, as I mentioned. And also, while underwriting this kind of customer, we always need to understand that we cannot sideline the regulatory and then compliances also. So while underwriting, there are few challenges comes. One is that when you are taking the alternative data, you are certainly not to take that data, and not on the basis of that data you can underwrite the customer, which is not comes under the fair lending practice. Like you'll in any ways you'll have to understand that you cannot take on the some community, some demographic, and then gender. You cannot be gender-wise for that matter. So this is a kind of challenge, no matter in case if your past experience, even if showing that kind of risk coming in the way. Secondly, when it comes to the underwriting and meeting the compliances at the same time, we form a team which is, for say, compliance team is always integrated with the product team. So we ensure when product is there, it is always integrated, and then at the same time we're meeting the compliance side also. We ensure that all, whether it is risk, legal, compliance, and then this credit underwriting team should be aligned together so that we cannot go with the risk of not meeting any of the challenge which may come after any compliance regulatory perspective, which is keep changing. Specifically, they should be updated enough and they should be aligned enough to take the call on at the same time. Let's say recently we have come with the changes in the co-lending guideline also. So when your three teams working together on meeting all the guidelines and then compliance, so that can be changed quickly. When any regulatory perspective, when any guidelines come from the regulator, it generally, you believe it or not believe it, but then it is majority is borrower focused. So when it borrower focused, what we always keep in mind that you should always be more communicative to the borrower at every step. So you meet those kind of guideline also, that in case if you are not make your customer fully aware at each and every step. So earlier we used to send messages to the borrower for any of the update or any change or any upcoming EMIs or any restructuring by the way of messages. But then now we always ensure that we are supposed to not just by the messages. Probably he may say that I have not read, I don't understand English. तो चाहे वो इंग्लिश में है, वो हिंदी में है, वो इंग्लिश में है, और we always try for the regional language also. By email, WhatsApp, we try to be at the best of our communication where we have communicated the information to the customer so that he should be aware of what changes we have made in either in the journey or in before the journey begins with us. So these are the challenges we keep, we keep focused that yes, if it is any regulatory perspectives comes, then we are fully aware of it and we meet with all the guidelines.
Thanks, Jasoda, that's excellent. Vivek, coming to you, and as a last question from my side before I open the panel for the audience to ask any to the panel. Vivek, in your opinion, how do you think analytics in underwriting is going to change or evolve. We speak about generative AI, we spoke about machine learning. In your opinion, how is this going to transcend in the future? While we all spoke about what's happening now, what's happened in the past, if you had to look at the crystal ball room, what do you think is going to happen?
So, if you talk about the future, what will happen? So, definitely, on the basis of alternate data as well as the revised credit underwriting, what the NBFCs and other financial institutions are following. So, definitely, the debt will be reduced. And if you talk about these kind of implementations, so many hurdles are also there, right, in end-to-end underwriting process. So if you talk about the first one, so we can say that there are so many challenges in the adoption of the new technologies from the FI or NBFC side. Because if you talk about the traditional lenders, still they are running on the CBS, right? So if you talk about CBS, so CBS is not API friendly, as well as if you talk about any integration with them, so it requires heavy customization, right? And if we are taking an example of NBFC, where the AUM of approx 500 CR or less than the base layer NBFC, so in that the migration is the biggest issue, right? So from converting to their legacy to the new system, LOS, LMS, the migration is the biggest challenge. And if you talk about the lending business, so in lending business, it's not only about the AUM growth or something like that, good figures, top line, bottom line. It is all about the collection also, right? Recovery also. If your collection is good, definitely you will achieve something. And if you talk about Agriwise Finserv, which is the part of the Star Agri Group, so we are also with the end-to-end digital journey, and we are working with farmer lending, we are working with lab, micro lab, all products are there. And we are live in tier 2 to tier 6 cities, right? So we have the end-to-end credit journey, but still we are working with the hybrid approach, right? So it's a digital documentation as well as the physical verification of the customer. So we can say it's a touch and feel model. Still, our credit manager is going there and understanding the customer requirement, what's your opinion, what is your intent to pay. So he still does that. If we talk about our promoters, they are from the Jaipur, they are Marwadi, so they still say, अगर किसी credit manager को पड़ता लगाना नहीं आता है, right? So he is not a good credit manager, or he is not a part of the risk team, right? So these are the hurdles, and definitely it will improve on day-to-day basis with the basis of their adoption as well as the integration with the new LOS as well as the LMS. Thank you.
Thanks, Vivek. I will just check from the audience if any questions for my esteemed panelists today. Happy to hear from you guys. Yes, please.
Thank you. Wonderful panel discussion. Good insights. So I was thinking about that unstructured data, structured data thing that came up. I'm just wondering, with all the numerous applications already existing within an organization, in general, how do you find them to be friendly to unstructured data? Most of them are designed for structured data. So I'm talking of things like collections, all the follow-up procedures once the customer has been onboarded. Are they friendly enough to unstructured data, or is that a challenge?
I'll answer that. One of my answers. The straight answer is no.
No, okay.
Okay? People have to get out of Excel. Everybody is on Excel. So I go to multiple panels and I speak. I said, unless you get your organization out of Excel, we have moved out of Excel. Of course, analysis, etc. can happen on Excel, but the entire assessment of onboarding and then doing credit committees and the cases have to pass through the LOS and then booked on the LMS, and the repayment schedule and cash and demand has to be tracked. That's also on the system. So unless, I know a lot of NBFCs today who are not on the system. They have a system, but it's very difficult for people to get out of Excel. right? So the plethora of systems today do not allow you to deal with unstructured data to answer your question efficiently. You will have to build something if you want to cater to. For example, if I have a supplier with multiple, if I have a anchor supplier model, and if I have multiple suppliers to an anchor, and if I have multiple invoices, I have built my own model, which can go and read all the invoices and transpose that and give me a tabulated sum total of something, or date, or those risk parameters on a invoice, right? Unless I build something of my own, and these tools are available today. But if I were to go out in the market and buy one OCR engine, I have to train that model on multiple invoices. So it is slightly bespoke, Manoj sir. Unless you build that and tailor-make it for your own business or entity, because NBFCs operate in multiple asset classes. So it's very difficult to take something, lift and shift, and then make it uniform. It is not possible. For example, we built our own LOS and LMS because there is nothing in the market which could actually cater to the products we offer, because we offer bespoke, highly structured products. So when you're offering something structured, you have structured cash flows. How do you have structured repayments? It may not, because you're solving for the lowest common denominator, generally, but it's difficult otherwise. Yeah.
I've got time for one more question. I can see we're leaving just 1 minute to 11:15. I think that's the time I've been told. So would love to be here through the whole day, but I'm sorry, I'm bound by the organizers. So that's how it is. So one more question, please, from the audience.
Okay, I'm talking about the alternate data. I understand traditional data is a passe and a lot of insight is required from the alternate data perspective, as Yashoda mentioned and Shalinee mentioned. I'm trying to understand, when we talk about alternate data, are we talking about the various government agencies and the various other private agencies providing that data, getting compiled from there, taking insights from the customer, or we are talking about the physical knowledge which the person who comes to, especially which happens mostly in home loans. I'm not from the finance industry, but I do not know how you do that alternate data insights for an NBFC or for a small SME or for an individual or a private person. I'm just trying to understand.
I get it. Yeah. I think the question is now clear. What's your name, sir? Mohan. Hi, Mohan. So I'll explain, right? Alternative data could be a mix of both. So your traditional data is your financials, something on the surface, right? You take the demographic details, the PIN code, address, all of that. That enables you to create a persona of the customer, and then you have to go peel the onion one layer and then figure out where does he stay, his income, the nature of business. So if it's a small player, depending on the asset class, and let's take a small business owner, it's a small factory which has a turnover of, let's say, 5-6 crores per year, has staff of 20, he's making some parts for forging and he needs a small business loan, and let's say he needs 1 crore, right, of working capital. How do you do this, right? So you have to peel the onion, first take the structured data, and then of course it's a periodic assessment of how his business is doing, because you want to release credit, and this is cash flow based financing, right? So unless you take comfort on the cash flow, what does his bank account speak? So you need to have analysis on his bank account. Are there too many delinquencies? Is he delayed on his PF payments? Is he not? How much? So all this data is available to you via a syndicated feed in API. But the unstructured data that Yashoda mentioned is also revolving around what does your visit say. So when the risk guy visits, is there enough activity in the factory? Are there too many trucks, or is it empty? Is there a commercial or economic activity happening in the factory? These are all data feeds that go into your propensity model to tell you that, boss, he has enough cash flow. It's not only cash in the bank. It is that cash coming in through activity which is already taking place in a factory. So this is secondary data, right? And then you build your model around it and then say. So it's a mix of both government data. It is a mix of both government data plus your own data that you gather when you do your audits, right? The risk and the credit teams, both in our organization, risk is between risk and credit. But generally risk teams, depending on which PIN codes you service through the country, you would need to go on a factory visit or a due diligence, periodic due diligence, and monitoring is done by risk, right? So it's the agglomeration of all this data which basically will give you a comfort that whether the customer is in green, amber or red. So the rack status, that's how we do it, and more or less Banks also have the same propensity model. NBFCs, which are tech-oriented, are slightly more agile when it comes to making such decisions. And you arrive at the customer door faster, assuming he goes delinquent. So the guy who has the data wins first, is at the customer, and the reaction times matter. And sometimes it matters between what you get versus what somebody else gets when it comes to delinquencies. I hope I answered it.
Just a point of observation to that. Are we taking advantage of the various agencies which are helping us build about the affluence index of that locality? Because when you are talking about personal loan or a small scale loans, a lot of insight today from the various agencies is available to help to understand the affluence index and how that particular locality is growing. And with the NASA night lights kind of technology available, one knows as to how the particular location is developing. And
So this is locational intel. I work with 2 startups. I mentor them, where they work on locational intelligence. So a good friend of mine, Rishabh Ladda, I'll introduce them if anybody is interested. They are a locational intelligence company which basically gives you pin code plus data, which would mean that it'll earmark geotag affluent locations, it'll geotag locations which are a no-go for credit. This was being done even 10 years ago, but it was done in a very crude fashion. Today, there is a lot of locational intelligence which is superimposed with artificial intelligence to basically tell you that what is the propensity of customers, staying in this pin code, average income, all of that, right? Which will then also enable you to build your model and decide that let me go after these customers who are living in this. So I think tech first, NBFCs, banks, etc. also take feeds from these platforms, which enable you to take a much more robust and prudent decision and keep your ECL numbers in single digits, right? So that's definitely rising. Many locational intelligence, I at least know 4 who are currently trying to solve this problem. I hope I answered that.
I had one thought just to share that whatever unstructured information data we collect, I think the informal, formal validation by the third party is very, very important. So how exactly it is done?
Sir, could you repeat the question?
My question is that when you collect the unstructured data from a borrower or a prospective borrower, whatever information is passing on in terms of whatever you are asking, is there a way that it can be validated by asking a third person? Because it's very important that what he is telling is genuine. How do I really validate?
So I'll give you a simple example, right? When somebody from risk goes for a DD, today we carry a voice recorder, right? So there was an experiment that we did in our organization that how many of you take notes on a tablet or their laptop, or how many of you, when you're actually interviewing the general manager or when you're actually just meeting, because if the client knows, the client has been with you for 3 years, and the client now knows there is a risk guy coming, right? The risk guy is generally unassuming, he's going there, so you're landing there unannounced, right? And you're recording the conversation. So I go speak to somebody in the shop floor, I go meet the finance guy, I go and meet the ops guy. So I'm getting data which is getting recorded, right? So there is transcription that is already happening, right? So this is done by my own staff. So let's say a AVP of risk who's going for a large customer who may have a large exposure to the tune of, let's say, 40-50 crores. Right, and it's a 3-year loan, right? And then I would go there every quarter or every month, depending on what my propensity tells me to visit. So if it is a volatile industry, then I would go make these visits faster and more frequent as compared to making infrequent visits. So these are all data that comes to me in an unstructured fashion, and then we put these. Any red flags? So truck nahi aaya, right? Production suffer ho gaya, pani insurance nahi hai, right? Aag lag gaya factory mein. These are all things that could happen, right? So these are then fed into our model and said that, oh, his stock is damaged, or there was only partial insurance, or that would then impact his sales offtake, which would then impact his cash flow, which would then impact his ability to repay. So it is all cascade, right? So I would need to then make sense of all of this and then say, okay, reduce or ask him to put in more cash collateral, or I would need to have more access to unencumbered cash. These are all things that you would need to make on the fly. There is no set model that you can consume or buy today and say that, abracadabra and it works. It doesn't work like that. So it is a mishmash of a lot of things, sir. Banks also grapple with it, but tech-first companies or tech-first financial service companies today have a lot at their table and lot at their disposal to make all this happen. Hence, I say that the bespokeness is what will help you. Yeah?
Yeah. So I think I'll just add one more thing. You talked about whether you do a validation with third party. We do that also. So there is a validation which is done with a third party. There is a validation which you do with your own data repository which you have built over a period of time, right? You know that you have lent a particular customer in a particular locality. So if you can store all the data with respect to that particular case, and tomorrow if some other case comes for that locality, you can validate. So so what we do is we throw those alerts, red flags to an underwriter that, you had done, a similar case had come and these are the red flags you need to be careful about. So this is sort of some kind of a data validation which is done. Thank you.
I think there's a whisper in my ear by the MC that, short of time. So I think I'll just say time out now. And anybody wants any other questions with my esteemed panelists or to myself, we can definitely meet after this panel. But I think to sum up, I'll keep it in 2 words. It's adopt and adapt is the mantra in underwriting. I think across the value chain, it's about how you adopt and adapt technology as well as data, and how you integrate it and how do you use it is, I think, what I heard from my esteemed panelists today. With that, I thank all my panelists for the wonderful sessions and to be a good sport with some of my questions. So the questions were a bit different to what I had actually put forward to them, but they were a good sport, and thank you for that. Thanks.